All right, let's look at an exercise that deals with some performance measures. Name of it is Compute, Disaggregate, and Interpret Return on Equity. Okay, well, some of these terms we may not be familiar with. There's a lot of videos out there about how to compute things, and that's what we're going to spend most of our time on. This disaggregate or disaggregation is basically the process of adjusting back in or pulling certain numbers out to get a pure view of what it is we're trying to look at. This is not something that you often will have to do, particularly if you're in a beginning class, but sometimes the textbook will have this in there. So good news is if we can do this, we can do it the plain Jane way. And then we're going to make some interpretation, mostly as it pertains to financial leverage. Okay. So we have this information for 3-year period for Intel, balance sheet, income statement, and we're going to focus solely on the year 2016 in the interest of time. So the requirement here for Part A says calculate Intel's ROE for fiscal year, and we're going to use 2016. So I've gone ahead and put the formula here, net income over average equity. So if we look here under the year 2016, we can find net income to be $10,316. And then our average equity, let's see here. We had equity on the last day of 2016 as $66,226. We essentially had equity on the first day of 2016 or last day of 2015 as $61,085. So let's go ahead and put those figures in here. So because we need average equity, we need to divide the sum of these two figures by 2. So we'll do that. 66,226 plus 61,085. Okay. That gives us 127,311, and now we're going to divide that number by 2 to come up with, let's see here, 63,6, we'll just go 656. Do pay attention to your instructions. I don't see anything here about not rounding intermediate calculations, so I'm going to round that 0.5 on the calculator up, and this is still just 10,316. Okay. So 10,316 divided by our average equity of 63,656 equals 16.2. Okay, so we're right on the edge here. This zero would probably round up to 1. So we'll say 16.21%. Okay. Now let's see here. I'm going to erase this line right here. That's not real clear what the number is. So we do this. So 16.21%. And you know, this is a figure that by itself really doesn't mean a whole lot. We really have to look at even more than 2 years to get any real indicator of how this 16.21% works as a measure of performance, a financial performance measure. Okay, but at least now we know the formula and how to calculate it, and both abnormally good and bad years. Okay, so that's all we have to do for Part A. Part B says calculate return on assets and return on financial leverage for each year. And they want to know kind of a qualitative question with a quantitative basis for the answer. Is financial leverage working to the advantage of Intel's shareholders? Use an incremental tax rate of 35%. You know, oftentimes when you see stuff about income tax, you can basically ignore it. This is not going to be one of those times. So I'm going to work through this question just exactly the way that it is intended that I work through it. So we have a formula here for return on assets, and the formula for return on assets is simply net income. That's not meant to be a plus sign, that's an asterisk. Net income over average assets. And I put the asterisk up here next to net income because that's where we are going to make our adjustment. So we've got a little bit to do here to get this answer. So we are going to start with the 10,316. Okay, this a little bit longer. And then what we're going to actually be doing here is we are going to add back the interest expense net of the tax benefit we get from it. Now that's an awful lot. Okay, so our interest expense, let's see here, I'm looking at the wrong year. Give me a second here. Interest expense for 2016, which is the year we're doing, is 725, and we're going to multiply that not by 35%, but by 65%. Okay, 65%. Where did I get that? 1 minus the incremental tax rate of 35% is 65%. Okay, so then we also need average assets, and if we look at our asset information, we're going to do the same thing that we did before, but we're going to do it with equity. So I will start with the current assets of 113,327. And I'm going to add to that 101,459. Last day of the previous year becomes the first day of this year. And then I'm going to divide by 2. Similar to what we did right up here, but with equity. Okay, so let's see what we have here for these two figures. I'm going to take this part in parentheses first. 725 times 0.65 equals 471.25, and then I'm going to add to that my amount of net income. So what we're saying here is if we want to, this is something that's necessary because the IRS exists, and this is just a way to get a more accurate return on assets. Okay, and if 35%, especially if we have really, really high interest expense, we kind of need to do this. So I'm going to add the 10,316. Okay, and that is 10,787. Heck, we'll just do the whole thing. All right. And then I'm going to add my 113,327, which is my ending assets, plus our beginning assets that we got from the end of the previous year. Okay, so this is our total for both. Now we're going to divide by 2. and we come up with 107,393. Okay. So our adjusted net income, 10,787.25, and our average assets, 10,393. I'm going to clear the calculator out. 10,787.25 divided by 107,393. And let's see here what we have here. We have 10.04%. Okay, and this is ROA. Again, this formula, because we did this little step, let me shrink this down real quick. Again, this, if we used a normal formula, this number would be a little bit different, be a little bit lower, because our numerator would be slightly smaller. I'm also going to give an indication of what that is here. Now we have to do one more thing on part B. It says, let's see here, and return on financial leverage for each year. So this is actually a fairly simple equation. All we're going to do, so ROFL, okay, ROFL is ROE minus ROA. So, in the interest of time, I'm going to bring these over here as, and I'm going to take 16.21 minus 10.04. Okay. And so we have 6.17% for our return on financial leverage measure. Okay. So that is 6.17%. And what would we say about that? Well, we would say that financial leverage, or the taking on of debt to create wealth, and we're not just taking on debt for nothing, we're taking it on to create wealth, appears to be working, at least to a limited extent. So make sure, again, that we look at this measure. This is a fairly uncommon measure, that we look at multiple years, because, again, any one year in isolation doesn't really help us a great deal. And then for requirement C, we're to use the Dupont formula. It says to analyze variations in Intel's ROE over this period. Well, we're not going to really be looking at any variations. We're just going to calculate it. One time. And so the Dupont formula is a return on equity measure, but unfortunately we don't have to do any disaggregating on this. It is strictly profit margin times asset turnover times financial leverage. Okay, so we're going to be calculating each of these, and then just to do it, we're going to get a new measure for ROE, and it probably won't be 16.21%. Okay, all right. So we already have the formulas here for us. So net income, 10,316 over sales. So let's look up here, and for the year 2016, we have sales of 59 10.387. So 10.316 divided by sales revenue of 59.387 gives us, let's see here, 17.37%. And I'm going to list these as a percentage right now, but then later what I'm going to do whenever I actually calculate the ROE under the Dupont, I'm going to kind of switch this back over to just a decimal. Okay, so sales, well, we already have sales. This is for the asset turnover, 59.387. However, it's average total assets, and we were able to calculate that up here when we were looking at a return on assets, and we calculated that figure as 107,393. Okay, so 59,387 divided by 107,393 equals, let's see what we have here. We'll go 0.55. Well, you know what? Let's carry it one more digit. So we've got 0.55, and I want to round this 2 here to 3. Okay, so times 0.553. Okay. And then financial leverage. I will say this, if you were to look up the formula for financial leverage, the denominator is fine here. You're normally going to see something like total debt right here, and that's perfectly legitimate. In the Dupont formula, they use average total assets here in the numerator spot. Okay, so let's see here. We have average total assets. In fact, we just used it, this 107,393, and we also have right up here our average equity. So we can just go ahead and plot those. So average total assets, 107,393 divided by 63,656. So let's bring the calculator over here and do that. 107,393 divided, whoops, let's see here, back up. I guess I have to hit clear. 107,393 divided by 63,656 equals let's just call it 1.69. All right. So now we have everything that we need. So I'm gonna convert this to a decimal point. 1737 times 0.553 times 1.69 equals 16.23%. And that is ROE using Dupont. Okay. So we came up with 16.23% return on equity using Dupont, and then without using the Dupont formula, 16.21. percent return on equity. So a lot of stuff going on here. This figure could be significantly different if we have any major issue with any of these items. If we had a very, very high asset turnover, sales over average total assets, or an extremely low rate, this could be an issue. We could see a bigger gap. The gap that we're seeing is almost no gap. But large companies do care about this, and so that is something to keep in mind. All right. Mostly what we're trying to do here is work through some calculations, but I do want to cover a little bit of the interpretation part of the question. We're going to close it out now as this video is starting to get really long.